Hi, I'm Dan Wilton, the CEO of First Mining Gold. First Mining is advancing our two flagship projects, the Springpole Gold Project in Ontario and the Duparquet Gold Project in Quebec.
Dan, good to see you.
Good to see you.
But you're passing through London. You've been whizzing around Germany. What's the reception been like?
Germany, Switzerland, it's been very, very good. You know, we have a very strong support base of largely individual shareholders. A few of our bigger institutions are in Switzerland and Germany as well.
Yeah.
Small but growing. And I think the reception is kind of reflecting where we are with the company and the fact that we are driving towards some major milestones. So
Right.
people, lots of our shareholders very excited about what's coming in the next year.
Okay, gold back in fashion across the board. Wherever we talk to people around the world,
Yeah.
people are excited by the gold price. Who thought? This year, right?
Yeah, we sat here at this point last year and it was about $1,900 an ounce, right? And maybe it'll get back above 2,000. Well, I made some bold predictions about a year ago, and it turns out I was very quickly right. So anyway, we'll see.
We'll see, but it helps. What has helped is the producers, though, right?
Correct.
Producers are getting a lot of love because they're throwing off money.
Yeah.
Money's a great cure-all. You know, you've got options with these things. So, but it's the developers aren't seeing that love.
No, and that's just it. We're seeing what I think really is a once-in-a-generation gap. I mean, I've been doing this for 30 years in my career, and I've never seen a value discrepancy between the valuation of producers and developers like we see now.
Right, okay. But you've got to try to work out how to take advantage of that, right? Okay, so if I'm looking at producers, they can do anything, do no wrong. There's lots of M&A, there's joint ventures, there's huge amounts of money going into exploration for the organic side of that equation as well. So life is good over there. I can see why investors are rushing towards them, okay? Because there may be even dividends. You never know. Values are going through the roof.
Yep.
You guys, you developers, there's not too many big developers. We've talked about this before in terms of that kind of 5 million ounce plus category. Because, well, first of all, why do you think that category should be rewarded better than they are now?
Well, I think those are the most strategic assets in the gold industry. You know, if you
What's that mean, strategic?
If you're a mid-tier or large cap gold company, you are not going to build a 100,000 ounce a year gold mine. It takes a certain amount of your organizational effort. And in general, for those mid-tiers, they need to see something that's 150,000 ounce a year plus. For larger, the larger tier of companies, they're looking for something more like 200,000 to 300,000 ounces a year plus. So they need it to be worth the size of the prize, to be worth the effort for them to get into it. And they are also the only ones that have the financial capability really to fund what could be $1 billion of upfront capex.
Mm-hmm.
So that sort of leaves a very small group. And then you factor that further in jurisdictions where really all of these companies want to own assets in Canada, the US, and Australia as their number one choice. So we focus a lot on, what is that larger group of larger projects in Canada? And it's a small list. And we've got, two of that larger than 5 million ounce camp. And I think it leaves us in a pretty unique position that way to have these assets that are also pretty substantially further down that de-risking path, certainly from an environmental assessment perspective, than most.
Okay, well, let's look at that. As an investor,
Yes.
I'm going to ask this purely as an investor who wants to make money, okay? I don't need to fall in love with you. I just want to make money, okay? So when you say there's a small group, what are we talking about? How many companies?
Talking about, by our estimation, 12 projects.
12 projects of the 5 million ounce plus category. Correct. That the majors would consider buying. So let's be really clear about what they're looking for. You talk about jurisdiction.
Yeah.
Maybe those three jurisdictions. The 5 million ounce component. What else do they need to have for an acquisition to be even on the table?
Well, most of them are waiting to see these projects get through some kind of permitting or environmental assessment milestones.
Permitting
as well.
of what?
Permitting of a large project that would look like it can produce, 200 to 300,000 ounces.
But what do the permits allow you to do, or allow those developers to do?
Well, the permits allow you to start building a mine.
Right.
Yeah.
Okay, so it's a build permit, right?
Yeah.
Then you've got the environmental component. Now, we've talked about this a lot over the last couple of years. Big issues down in South America, well, all over the place.
All over the place.
Right? And there's another stat, which we read the other day, which kind of made me sort of draw a breath, which was from discovery through to production, it used to be 12.3 years.
Yeah.
Okay, and I'm talking only 20 years ago.
Yeah.
That's kind of right. It's now 19.8.
Yeah.
That's a very long wait time from discovery through to production.
Yeah.
Okay? What does the environmental element add more time on top of that 19.8? Or, I mean, how do you view that process today? Because it's like a new process in a way.
Yeah, well, that environmental, your environmental licensing, your understanding the environmental impacts of the projects, I think is a significant part of the reason why the development time's gone from 12 to 19. In that companies are expected to understand more about the environment where they're looking to build a mine. Companies are expected to develop relationships and be able to demonstrate how the development of these projects is going to benefit local communities, which is part of that social licensing that comes with it. So that's something that is far more of a focus than it was 20 or 30 years ago in the mining industry. And it's important. It's a really important part of responsibly developing projects.
Okay, so that's a kind of preventability element, and then there's got to be an accountability element as well. So in terms of these, it's red tape. To an investor, I'm looking at this saying, Christ, that's red tape. Just get on it. Yeah. Because I care about the money, but you guys have got to be very, very careful with all those kind of stakeholders. So it's not just time. Well, time is money. It's also money.
Well, and time is money. The reality is, if you have a company that is not producing gold and not generating cash flow, like most of the developers in our peer group, the longer things take, you have to keep a corporate infrastructure around for, that many more years at $3 or $4 or $5 million a year in a period where we've had really challenging access to capital. That really does become a pretty existential threat, that time frame to you being able to do work. And the other part of it is, if you're in a market where, let's say you can only raise $10 million a year, the productive work you're going to be able to do with that 10 million, if you have kind of a base of 3, 4, or 5 that you need to kind of keep a corporate entity going, and that's just having the talented people on your team who you need to be able to do the work. It's being a public company. It's, talking with your investors. But it chews up a reasonable portion of what has been that limited amount of capital that developers have been able to raise.
So have you done it? Have you managed to raise the money?
Well, a big part for us is, we had this portfolio of other non-core assets. So starting in 2020, we had raised a bunch of money, but in a decent market, we started going out to actively find partners and start to slowly monetize these other assets. And that for us has turned into $60 million of cash over the last 5 years. And no one gives us much credit for that. But that $60 million, when we're sitting today with, call it 140, 150 million market cap, like you think about what the dilution impact of that would have been if we had had to just raise it in equity. It's really significant. It's allowed us to take that money, and that basically those proceeds have gone directly into the work that's allowed us to advance these projects through environmental assessment, through engineering studies, and then, in part helped us do a little bit of exploration around those projects to demonstrate a growth profile as well.
Well, explain that, because like right now, the drilling, I've seen some recent announcements, I looked at the share charts. After the announcements, no one cares. That's why do the drilling at all? You've got 2 5 million ounce projects. It's enough, surely.
The only thing better than a 5 million ounce project is a project with 5 million and 2 ounces, right? Like it just further helps differentiate the project in terms of other opportunities that larger companies might want to come and partner with you on. In large part, a lot of the drilling is going to demonstrate not just ounces that we know are there now. When we think about Duparquet, the scale of the opportunity, we think, is looking at the ounce base that's there today, and then what we think sits in the next 500 meters down. And so a lot of this exploration has been really important in demonstrating the potential for this growth trajectory that would take it from, the levels where it is today towards 10 million ounces. And that even further differentiates this project as something that could be a really significant development project.
Has it helped change your share register at all, or is this more
No.
about potential buyers?
I think it's ultimately about the industry. It's about demonstrating to the industry that, there's an ongoing growth profile, not just from the ounces that are there. Our PEA at Duparquet only showed us producing 2.5 million ounces over an 11-year mine life. So there's lots of other extra resource there that, needs more drilling, needs to be understood. But no, I think really for us, it's not about defining resource even at this point. It's just about demonstrating the trajectory and that potential that underpins what are already, assets that if you look at just the valuation from our technical reports, demonstrate at, $1,600 and $1,800 gold price, demonstrates $1.80 plus of net asset value per share, right? And we're trading at 13 cents today. So there's already that kind of trajectory that's built in.
We'll come on to that. Look, it's not a case of just trying to look busy in a quiet period.
No, it's really demonstrating, and it's a very important box that large mining companies have to check. It's fine if you have, a large resource, 5 million ounce resource that's there, but it's cut off, it's defined. Everyone then says, well, it's great, but we need to see the exploration upside. So the importance of what we showed at Springpole with the Springpole East drilling is actually opening up a vector that could be millions of ounces in addition. But the really important part of that was some of that drilling that we were doing demonstrates that things that are in our pre-feasibility study mine plan as waste are actually ore. And converting your waste to ore is one of the highest value things that you can do. Okay. Just because, in the next time you're doing that study, that is additional resource that's going through the mill. Your previous model already paid to mine it.
Right.
They had just taken it to a waste dump, but now you're actually getting it to pay for itself.
Okay. Okay, I'll buy that.
Yeah.
Let's look at these 12 projects, potential 12 in the universe of 12 projects, which are attractive to majors or mid tiers who need to backfill some of the resources or reserve numbers, right? You've got 2 of them.
Yeah.
Let's start with that.
Yeah.
That's not too shabby.
That's not too shabby.
Right.
Yeah.
So as a percentage, you're a big player there. But you must set yourself up so that people looking at this thing go, this is economic. This has not got too many more hurdles to get through. The big one being the environmental, right? So let's try and really get into, well, what's the environmental involve? How long does it take?
Yeah.
And how many people are in that process at the moment? Because I want to bet on the guys at the front of the queue.
Yeah.
Not the guy who's just starting it down here, right? So first of all, how many other people are, have submitted?
In terms of submitting a final environmental assessment, we are the only other one in that group I think would be Falco, which is going through, but they'd submitted and had some kind of start and stop in that process. But they're, I think, in the final stages. I just don't know the scope of their submission, federal versus provincial, and I'm just not that familiar with their process and where they are. And the other one would be Skeena, which is making good progress. They've actually been able to substitute out the federal government, so they haven't had to go through the federal process. It's all being done provincially. And with their, as I understand it, with the Tahltan, their indigenous community around the project, having a significant role in kind of the governance and monitoring of that project as well, licensing of it. So
3.
we think
I've got 3.
3.
Okay.
There are others who are going through environmental assessment in the province, but not in the federal, when by all other estimation, I would think that, it's a large project you're building and you're diverting water courses, like typically I would think that would go in. There's a few others who, are completing the baseline data studies. So they're collecting 3 years of baseline, which to me says they're still at least 3 years behind where we are now, because from the submission of, when we submitted our draft EA in 2022, that was having collected baseline data for, in some of that data had been collected for 8 years at that point in time.
Right. Okay.
So I think if you are super well funded, your head's down and you're driving forward, look at the work that they're doing at Great Bear, for example, that Kinross is doing. It's about 100 kilometers from Springpole, so we watch it pretty quickly. If you're well funded, I think you can credibly go through that process in a 5 to 6 year time frame. But here's the thing. No project's ever been approved under the Impact Assessment Agency Act of 2019.
Well, not approved because no one submitted, or not approved because no one's got through it.
Because no one's got through it yet. And
there's only one. People have tried but failed.
No,
or people have not.
No one's got that far through the process yet.
Okay.
No, as we were talking earlier, that Canada Nickel has just submitted what I think is the first impact assessment report under the 2019 Act that's ever been submitted for a mining project federally. So, and that was, I think from, discovery hole in 2019 to being here at the dawn of 2025 is moving remarkably quickly. But, they then have to go through, I think, the rest of the process. It's slightly different, but kind of where we were again, another 2.5, almost 3 years ago. So, we're...
It sounds right. It's a absolute must-have process, but it's quite onerous to get through. I think you were saying something in a previous conversation. They came back with a long list of questions.
Yeah, in the draft EA process, it was 1,900 plus comments and questions from regulators, from Indigenous communities, from other local stakeholders. So, we've it was a super helpful process. It led to some real improvements in the project design that we'd carried through into the final EA, that we'll carry through into the final feasibility. It's a great iterative process, but what it means is when you submit the final EA, which we did 3 weeks ago, it goes to them with a table that has all of the 1,900 questions that they've already asked, and tells you where those answers are incorporated into that document. It also added 5,000 pages to our environmental assessment. So it's 15,500 pages right now.
1,900 questions. That's as many questions my wife asks when I watch a movie with her. But who's on the film? So that is a very long, drawn out process.
Comprehensive process, and a lot of back and forth. And that's the important thing to understand is if someone is saying, okay, well, I've submitted my final environmental assessment. You don't have to go through that draft process.
Yeah.
We went through that draft process because our team, when they permitted the Greenstone Gold Mines project that Equinox has just finished building, they went through a draft process and found that was, maybe took a little bit longer. Yeah. But it was invaluable in taking risk out of the project and really understanding what the issues are that regulators and communities are concerned about. So, we think there's still a lot of work to do. Don't get me wrong. Sure. Like this, there's a lot of important work, particularly with the Indigenous communities moving through this part of the process.
Absolutely, and we'll come on to that as well.
Yeah.
But once you submit, how long have they got to respond to? How long drawn out is this?
So in the federal process, so we submitted 3 weeks ago. It's going through a conformity review to see if it conforms to the terms of reference that we had. From the end of that conformity review, it restarts the clock under SIA 2012, which is the act that we are in because we're grandfathered under the old act, which is the same act that's given.
How many days, Dan?
309 days left on the federal clock.
So it itself is not hugely drawn out.
Yeah,
but nevertheless, you need to get through that. You've got other things to do.
Yeah, no, and that there's more comment response that we will go through when they have comments and they send them to us, it stops the clock and we have to formulate responses and go back. So, but we are factoring in a reasonable amount of comment response time back and forth, which is similar to what our team saw when they did Greenstone. We are all working towards targeted approval at the end of 2025.
Okay, I want to share with you our investing hypothesis. So we got out of gold when the market started getting a bit wonky. Yeah. And we got back in at the end of last year. Gold.
Yeah.
Okay. Because the usual rules did not apply.
Yeah. We
went for producers.
Yeah.
I think we've been right.
You have been right.
The share price and the gains have been shown that we are right.
Yeah.
What's next is developers.
Right.
Okay. I think explorers is, again, a tough ask. It'd have some quite spectacular for me to put my money into that. Developers, these 12 assets that you talk about, not necessarily 12 companies, but 12 assets that you talk about, we are into those because here's what I think. I think there's been a mismatch, or the price has not actually any relationship with the value of those companies on a fundamentals basis. We think, right? Yeah. And I think in a normal market, they would be 2 or 3 times that, depending on the asset. And I think if the companies, this is why I'm trying to understand where you are in the process, if those companies can demonstrate to me they will get built, I want a clear understanding about the economics, obviously, and this gold price, maybe it covers up a multitude of sins, but I kind of don't care, right? So I want to identify the companies who are closest because I think that's going to give me the quickest reward. That's not to say maybe you shouldn't invest in all of them, but there's some which will probably stand out a bit because I don't necessarily think all will get.
Yes, you have to have a bit of an assessment of, so the economics of the project.
Tell me I'm wrong, and then more importantly, tell me where you think you are in that mix.
So I don't think you're wrong at all. I think you have the thesis, and we lay it out in our investor presentation very clearly. I think we're sitting today at a once-in-a-generation discrepancy and dislocation between the value of producers and the value of developers, which is only going to get worse because the producers have, by and large, not been investing in increasing their own capacity. And they're going to need to because the last time I checked, this is still an extractive industry. And when you mine an ounce of gold, it's gone from your reserves. So where we are in that is, I think, for large assets in Canada, which we put forward the thesis that, those are the premier assets in the gold industry. And I think you can look back over the last 10 years at the values that almost every 5 million ounce plus gold project that's been acquired or funded in a JV, once it's received its environmental assessment approvals, almost every one of those gold projects has been acquired or funded at a valuation of $500 million or more. And we've got 2 projects that meet this qualification inside First Mining. So then the important thing is, where are you in these critical de-risking elements? Which technical de-risking measured by a feasibility study, and environmental and permitting de-risking measured by really what is the key milestone, which is getting your environmental assessment approvals.
So let's deal with that one by one. Okay, Springpole, we'll start with that. That ticks, I guess, some of the boxes already. You're going through the environmental moment, right?
And we would say that Springpole in that list of 12 would be very much at the front of that list.
Okay.
There's
top three.
One of them is an Agnico project that already has its EA approval, but has more or less been on the shelf for years. So kind of discount that.
But that's the point, isn't it? It's like not everything is as advertised.
Correct.
Always, right?
Yeah.
Some projects will go through a process, but not get over the line, as it were, right?
Yeah.
And others will, let's say, in this kind of gold price environment, it'll be just fine.
Yeah.
Right. Whereas probably wouldn't have been this time last year.
Well, and I think it's interesting to understand, we talk about the leverage that these big projects give you to the gold price. I mean, for us, it's every $100 in the gold price is $250 million US of after-tax NPV.
What's a year for you?
Well, and the interesting thing is, we know there's been capital and operating cost inflation, but you can put parameters around that. We've done some updated internal scoping studies. You can put parameters around that inflation. And even in kind of your worst inflation scenarios, and if you think we were wrong in our forecasting of capital and operating costs a few years ago, like a $2,000 gold price solves a lot of those issues. And then you start thinking what this looks like at $2,500 gold price. And everyone says, but all the costs have gone through the roof. It's not like that. No, but here's the reality. $70 oil. Yeah. You're an open pit mine. You're going to use a fair amount of diesel. $70 oil is pretty low. The cost of steel, structural steel, is probably 50% lower than when we quoted it in our PFS. Like, not everything has gone up. Labor has gone up for sure.
Yeah.
Some of the equipment cost has gone up, reflecting increased labor, that period of inflation. But a lot of your consumables are at actually levels right now that are super attractive, which also makes you think, how is it that the producing mining companies are not making even more money? So
And so, I mean, to that end, would you look at revising the economics? You're going through that process at the moment. What do you think that's going to show?
So we're about 90% done a feasibility study, and
Right.
we had advanced that work from 21 to the middle of 23, just to do all the things that take a lot of time. So we think we have a very good understanding of the risk, and anyone coming in from the outside to look at the project, you have a very good understanding of those risks and what it would cost to build. You need to update that for a final feasibility study. We need a little bit more geotechnical drilling, which we just haven't had in the budget because it hasn't been a real priority, in large part because we didn't want to do 2 feasibility studies, right? So we got all the work to a point where, we can pick it back up. So our goal is to do that after we get the environmental assessment approval.
Okay.
Focus right now at Springpole is we got to get to the EA approval, which is now about 12 months away.
Yeah.
And another real focus of trying to advance the discussions with the Indigenous communities that we're working with.
Well, talk to me about that, because obviously they're the ones impacted on this. They've got to buy into what you're trying to do and understand the benefits or negatives, whatever they think.
People need to understand both. That's
right.
Yeah.
What is that process? How much effort, resource are you putting into that?
A lot.
Right.
With a couple of the communities, we announced that we're funding an Anishinaabe-led impact assessment, which is a pretty unique process that the communities wanted to go through to look at basically a lot of the technical detail of the project and the plan that's described in the environmental assessment, but look at it through an Indigenous lens. So over the last couple of years, we funded the development of that process, which never been done before. So it was an extensive process by the communities to frame how they wanted to do it.
Yeah.
And now the execution of that process is going forward. And our goal is to try and align that process with the environmental assessment process, because there's a lot of the EA work that sort of needs to feed into their Anishinaabe-led impact assessment. But it's fundamentally, it's the community's process. It's not our process.
Okay, so you're not shoehorning it into the environmental process. This needs to actually work operationally on the ground, because if it doesn't, nothing. It's not terminal, but it's going to delay things.
No, the reality is we are very much working toward securing the consent of the communities, and this process is meant to be a very important part of the communities working through and building their own understanding of the project in order to have the information to be able to make a decision about the impacts and about potential benefits and whether the communities want to sanction the project.
That is what any acquisitor will need to see as well, that there's full sign up to that before they hand over a check to you as well. So the environmental is one thing, and obviously this being a major part of that as well.
It's a very important
license.
part. It's a very important part.
Yeah. I think there's been a better understanding of that over the past few years about the impacts, positive and negative.
Yeah, and recognize that this project is really a generational opportunity for the communities in this area.
Yeah.
And this would be potential to really, really significantly positively impact the people in those communities.
Got it. Duparquet, PEA.
Yes. So we did one last year. It was great.
Well done.
Yeah.
I'm going with the usual question. Well done. What next?
What next?
Yeah.
Well, we actually took that PEA and asked about a year ago, what's next. The reception to the PEA was, call it tepid.
Muted.
Yeah.
But in a difficult market, it's kind of people looking at these long horizons ahead of them, like, oh. Well, and I would always say this.
Yeah.
The retail environment that we have lived through in the last 4 years has been huge value destruction at the beginning of it.
Yeah.
So that's mining's fault, generally, the market's fault, and lots of shorting and naked shorting, all that kind of stuff that people like to throw out. And the Fed did this, crazy. But the truth is, we've been taxed to hell by our governments. We've got less disposable income, therefore less discretionary spend. And when companies like you say, oh, we're the best thing out there, it's like, well, you're all saying the same thing. It's very, very difficult for retail to go, this is a sure thing.
Yeah.
Right? When gold price moves like it has, with an advanced project like yours, in rarefied air in terms of the size and attractiveness, then I can feel myself listening and leaning into that.
Yeah.
So I'm not surprised.
Yeah, it's understandable. Right? It kind of came out at a time, but it also, we wanted to scope the project to demonstrate what we would say is its strategic nature, right? This is a project that can produce more than 200,000 ounces a year, located in, I would say, unquestionably the best jurisdiction in Canada. When you look at the Abitibi Gold Belt, it's one of the premier areas in the world that large companies want to have projects. And I think if we faced challenges in that perception, it was, oh, great, it's another big project. You know, it was a little more than 500 million US of upfront capital, which is pretty manageable.
Yeah.
But still another big capital project for Little First Mining Gold. And if we were going to build a 15,000 ton per day mine and mill at Duparquet, we're into a federal and provincial environmental assessment process. And so immediately we're starting to talk about those timeframes that are going to put this project well outside people's.
So what's the quick win here? Do you revise the kind of cost structure and reissue a PEA? Because the PFS is going to take a lot longer, right? Do people need to understand in today's cost environment, as you've just described, you know, price of energy's gone down, people may be up or stay the same. You could say, well, let's just take a look in this new world of ours now, post-COVID pricing, etc. It's actually more attractive than you think. And we're going to put the gold price in here. We can sort of do it and say, well, the economics, PEAs are what could this be? Pre-fees is what should this be, and feasibility being saying what this will be. You know, different sorts of risk on, you know, plus or minus 30%, all that sort of stuff. But how do you do some quick wins with Duparquet, or do you not bother because the focus should be on spring coal?
No, I think you've hit the nail on the head. We went back in retrospect and said, what is there a different way and a different time frame that you might look at this project such that you're not maybe necessarily building a big project, right? Okay. Maybe there's a smaller, higher grade, higher margin project that
quicker to revenue, less dilutive. And so we started looking at those types of opportunities. We're just finishing up some trade-off work on that. If we like what we see, then I think that could be turned into a PEA reasonably quickly. But I think what we're seeing there is exactly what we thought we would see. There is a higher grade, you know, don't want to use the word starter pit, but there's a higher grade subsection of that pit that looks like it could be really interesting and economic and basically be the basis of getting a project into production that's not only going to start in the mining in the open pit, but give you access to some underground where we're having some really good exploration results, and think that could start building out a different underground story. But importantly, it also gets you started on what is, you know, essentially an environmental remediation project around some of the historic environmental legacy, particularly the historic. Does that speed things up? I know it's a smaller, less capex, less onerous from that point of view, less dilutive, all of those good things. But is it any quicker in terms of the environmental onus on that particular project?
Depending on how you scale it, you have the opportunity to permit a project just in the provincial permitting regime in Quebec. It's a great place to move projects forward. So yeah, we think that there's a scenario there where that looks like, you know, kind of a 3-year process. So one of the important things that we're starting to do next year is collect that environmental baseline data, which we're fortunate that there was a thorough environmental baseline report done when the project went to pre-feasibility in 2013. So it's interesting, by updating all of these different characters of environmental assessment, we can actually get a 12-year trend line with 1 year of data, which is really valuable from an environment perspective. And I think can justifiably give you the information you need to know that you can design a project with, you know, again, with the environmental safeguards that it needs to be able to produce. And if the threshold is not making the environment worse, that's one thing. But I think when you look at it through the lens of we're actually taking care of an environment that was disturbed 70 years ago, and by the way, we're kind of the only people that have done anything about this in 70 years. It's a pretty positive story for the local community, for the Ministry of Environment in Quebec, So no, we think there's a really, really important framing of this project, which is like, let's just get going.
Okay. And for me, the investor, I know you were having to be patient as you go through a process with Springpole, right? And you were saying maybe some of the options around Duparquet, I get it, earlier to cash flow, less need to raise big amounts of capital. But a sale, does that solve anyone's problems? People keep asking this all the time, right?
Yeah.
Sell one. You got two, sell
one.
Get some money, finish the project properly. I mean, why is that not the thing to do? Why is patience required?
I think patience is required in large part because I think the path on Springpole goes more down a partnership path in the end.
Okay.
So I think if
Meanwhile, so describe one that has out there, or there's a couple of options for us, because I understand what partnership means, but it says what the economics of something like a deal could look like.
Let's look at what happened with Windfall, with a Cisco, right?
Yeah.
They had Goldfields who came in to a 50% joint venture interest in a project that was funded at a valuation of about $600 million. And then a year later, Goldfields came to buy the other half of the project for $2.2 billion. Similar size project. They're different. It's a high grade underground deposit. So you have to understand some of the different risks and rewards. I think history is going to show that, obviously the Goldfields folks had real conviction in this asset. I think for us to find a partner who's going to spend that next risk capital, you look at some of the values that large projects have been funded in Canada. You look at what the original funding at Greenstone was when it was owned by Premier and Centerra. The Centerra spending $300 million to earn into a 50% interest in it.
Yeah.
That was 6 years before environmental assessment approval, right? So, and that project then got purchased by Equinox and Orion at $600 million. With its permits intact, but $600 million US. I think those are kind of pre-construction. So I think those are kind of the frame of opportunities that we see here, because there's just, as we talked about before in these permitting timeframes, there's not going to be anything else really to build, maybe one or two other projects, but not much else to build in Canada between now and 2031 or 2032.
So if I'm one of these majors or mid-tiers, I've got a line of sight as to what's coming up behind.
Yeah.
I can see that now. They're doing some work on this. They're following all of these stories, and they'll have a view of what's real and what's not, and what suits their portfolio and skill sets and what doesn't. But I think what they can all agree on is the pricing of these assets and these companies is all-time lows, I think. Yeah. And that is cheap as chips for them.
Yeah.
I mean, pocket change.
Yeah,
really.
And the other thing is, what's the average mine life of the assets that they own right now?
Exactly.
There's maybe 7 or 8 years, like reserve life. And if you're going to wait 7 years to start building a project, you're not going to.
Really good point.
You'll hopefully extend that a little bit, but then your other assets are going to be in their twilight.
It's such a good point, actually. It's that assessment of their current portfolio, which they will do, but maybe investors should also have a quick look around. They're being offloaded at the moment. There's a few, they're offloading stuff which just no longer meets their profile that they want in their portfolio. So they're offloading it. So it's a little bit of cash, but it's also a lot less responsibility.
Yeah, no, certainly we've seen that with Newmont, right? Yeah. And some of the valuations that have been paid for these projects are
fully priced.
Very healthy.
Yeah, fully priced.
Yeah.
Because, and again, that comes back for people watching this, that's because those assets are worth more to another group than they would be to Newmont, and Newmont know they can get away with it. So people may want to start a project, they may want to, they may need the ounces as part of the portfolio. Yeah. Lots of reasons why.
Risk diversification.
They think they can do something.
Yeah. Well, and the other thing that actually plays into all of those financing, because they're currently producing assets, is it, the long-term valuation that's ascribed to most of the companies is at a long-term price deck of $2,000 gold, maybe, or $1,900, or wherever the banks have their long-term price decks now. If you are borrowing against your next 2 years' production, you're selling it forward at $2,700 an ounce, right? So there's potentially $600 or $700 an ounce of free value
Yeah.
that the bank will give you cash for those things. And
Yeah.
people don't think about that, but the financeability of those large production packages, even though they might only have, 6-7 year mine lives,
Yeah.
the next 2 years, when you factor in that you're getting an extra $700 of free cash flow margin on a couple 100,000 ounces, like that is real money. And that's partly what I think has come in to allow some of these sort of premium prices to be paid.
Yeah.
And some of it is obviously they have to have conviction that there's exploration upside, and two that have sold are good
Yeah.
assets, and particularly Musselwhite, has
Yeah.
had a 7-year mine life since they started in 1990.
It's appropriate for them, but not the big boys. And that's what I'm focused on. I guess the other side of that coin is the fact that, one, that's a bunch more money in the bottom line for Newmonts of this world.
Yeah.
And two, they can get after the companies that do meet the profile
Yeah.
today. Whatever stage they feel comfortable coming in at. But the point is, it's got enough ounces that they can run this thing for another 15, 20 years.
Yeah.
That's what they want, not the companies which no longer, or assets no longer meet their requirements. So,
Well, then I think when we're talking about these acquisitions too, I think a lot of these companies and their investors have concerns about paying a big price to buy an asset pre-construction, right? And that's why for us, when you say, if someone comes through with an offer to buy one of our projects that we think is good value for our shareholders, then, you'd have to consider it. But rather than someone have to pay a big price and then face 100% of the construction risk and, cost overrun risk or whatever, I think it's a much more attractive process for someone to say, okay, well, we're just putting the money in the ground and we'll maybe take a little bit less of the project right now. But our risk is actually, the spend is going to de-risk the overall project. And I think when you look at how that played out for Osisko, I think it's a really interesting opportunity for us because there's a scenario with First Mining that we're sitting here in 2026 or 2027 on our way to becoming Canada's Gold Road, if you're familiar with Gold Road in Australia, right? 50% ownership in a 300,000 ounce a year producing mine being operated by a large cap partner. Like, we have another asset now that maybe we've scoped in a bit of a different way, and that could be more of a controlled self-developed project. I think it leads to some pretty interesting thoughts about valuation.
Yeah.
If you think that you can get there without a ton of dilution because you can leverage the asset value of these things.
I guess my takeaway from this conversation is, just as miners, producers can only dig it out of the ground once, right?
Yeah.
That's the nature of the beast, right? But then the gold gets put back in the ground in a vault.
Yeah.
Right. But there it shall remain. And I'm wondering how do I view you? And it's kind of in the same way. Your asset is in the ground. You got the gold. It's in the ground. So maybe I should be a little bit more patient with when I expect my returns to come, because when they come, they will be meaningful. But give you the time to go through the regulatory processes that you need to go through.
Yeah.
And let's see if you can't deliver on some of the things that you hypothesized about.
And I think those, it's a different time frame. Like when I started here as CEO in 2019, sure, we thought we'd be through a lot of this stuff in 4 or 5 years, and we're now on 6 years, right? And I think we've done a good job of it, but these processes are kind of running through to their conclusion. The time that the new investor has to wait is not going to be that long for these catalysts. And it's getting more and more defined all the time. And I think you'll see that as we go through the CA process in the next year.
Yeah, and it's going to make clear as to how long it takes for those who sit behind you, whether they have 1 year into this or haven't started yet. I've got a sense of what that looks like going forward. Even if with cash, if they can expedite it, it's still a long, drawn-out process for them. Interesting conversation. Thank
Always
you
a pleasure.
Today.
Yeah,
thank you very much for your time today. Glad the Europe trip worked out for you.
Yeah, it's good.
And good luck with the environmental process.
Fantastic.